right, good afternoon, everybody. Welcome to tonight's webcast, How to Swing Trade Breakout Patterns. My name is Jerry D'Ambrosio. Hope everybody's doing well. Had a good day today. I do want to do a quick sound check just to make sure everybody can hear me okay. If you guys don't mind, just use that either GoToMeeting or YouTube chat box just to let me know that you can hear me. And then we will get started. Pretty good turnout here for a Wednesday evening. It is 6 o'clock here on the East Coast. Mike says good. Richard says yep. All right, looks like everybody can hear me okay. Fantastic. All right. Well, again, guys, my name is Jerry D'Ambrosio. I'm the manager of educational content with VectorVest. I am one part of our fantastic education team. Our number one goal is to make you guys better traders, better investors. We want to make sure that you understand the ins and outs, every feature, every tool within the VectorVest program, and through that, we'll teach you different types of investing techniques, different trading techniques. Our education team is really broken up into a few different factions. I think, we have our option guys, Jim Penna, Ron Wheeler, Brian D'Amico. We have our trading or swing trading faction. It's me, Steve Chappell, Glenn Tompkins. And then we have Todd Schaefer and John Marabu and also Brian D'Amico. And they kind of deal with the, what I guess we call investing 101, area where you're just looking for, simple ways to use the program. Don't want to get too in depth, but we have something for everybody. So today is going to be all about breakout chart patterns. So, it is going to be a swing trading technique. This is not necessarily these techniques that I show you here today, not necessarily something that you would use in a retirement account, but this is for the portion of your overall investment capital that you have set aside to trade a little bit more actively. Okay? Now I do want you to stick with me to the end. We're going to be together for about an hour, so if you do stick with me to the end, I will share with you a copy of today's slides. Now I sometimes forget, right around 6:50 Eastern time, about 50 minutes from now, if somebody just reminds me, say, hey Jerry, don't forget about the slides, I will put them in the handout section excuse me, of your GoToMeeting control panel. But just somebody remind me at the end, because I sometimes forget. I got a lot of content to cover here. And this is one of my favorite topics to teach. I really like breakout patterns. And what we're going to talk about today are continuation patterns. Now, there are a couple of different types of breakout patterns. There's reversals, okay? That do require a breakout of some sort, and each reversal pattern, has a very unique, particular breakout level for that individual pattern. Today we're going to talk about continuation chart patterns. Okay, continuation chart patterns, it says, can be sideways or counter trend price action that represents a pause in the current trend move. So we're going to be looking at bullish patterns today. So the current trend move is an up move. Okay, so you experience an up move, a rather sharp up move for the first pattern that I'm going to talk about. And then you get a pause, sideways, counter trend. Sideways meaning, a consolidation period that moves sideways in a rather narrow sideways channel, or it can be downward sloping. Okay, downward sloping counter trend price action. The next move usually is in the same direction as the trend before the pattern. Okay, and the two continuation patterns that I'm going to teach you here today, number one, flags, bull flags, and triangles. Now there are different variations of continuation triangle patterns. Okay, for example, let me just, there we go. There's what's called a symmetrical triangle. Symmetrical triangle looks like this. Okay, you have a downward sloping trend line, you have an upward sloping trend line, and price is getting squeezed tighter and tighter, retracing from the lower trend line, retracing from the upper trend line, and then something's got to give. And in a bullish situation, we would look for a breakout to the upside. That's a symmetrical triangle. There's another triangle called a descending triangle. Looks like this. where the two lines, the two lines there intersect. But in this case, with a descending triangle, you have a level of support. However, that level of support is accompanied by a pattern of lower highs. Okay, so the buyers, bulls, are holding this level nicely. They're a little bit concerned because the sellers, the bears, are putting in lower highs as the buyers and the bulls are establishing a nice level of support. You know, something's got to give here as well. This is a potentially a bearish formation, and generally speaking, the next move will be to the downside. All right, and then the triangle we're going to talk about today is called an ascending triangle, where you have a level of resistance, but an upward sloping trend line. So in this case, you have a level of resistance. The sellers are doing a good job, you know, forcing price to push down off of that resistance level. But the buyers are putting in higher lows. This is a potentially bullish formation. We look for a breakout to the upside, and that's the triangle that we're going to talk about today. Okay, so the two different continuation patterns, flags. We'll talk about bull flags and triangles. So a flag pattern, some characteristics of a flag pattern is they appear in strong uptrends. Very important. Okay, now we'll be looking at charts like 3-month charts. You know, it doesn't necessarily, so the uptrend or the strong uptrend doesn't have to be like a new 52-week high or anything like that. It could be a new 3-month high. We're looking for a swing trade, so we don't have to, that uptrend, that strong up move doesn't have to result in a 9-month high, a 1-year high. We'll look at 3 to 6 month charts. I think that's enough look back where you can determine, has price been moving higher? Has it been trending higher? And that strong uptrend, or excuse me, the next bullet there, the sharp up move should be resulting in a new high. Okay, and that sharp up move is then followed by a down sloping or sideways price behavior on light volume. And the sharp up move needs to be accompanied by high volume. You know, it's not necessarily there's no amount of shares traded that's needed. You have to recognize this is a cherry picking technique. There aren't any searches to find this. I want to make that clear because I know that there'll be some questions about, is there any VectorVest searches that find flag or triangle patterns? There's not. This is strictly a cherry picking chart reading technique. I think that's important. I love scans. I'll use scans quite a bit, but you know, every good trader knows and learns how to read charts. They understand patterns, they can recognize them. So a sharp up move on low volume, that's not bullish. That's not acceptable for a flag recognition. The sharp up move has to be accompanied by high volume, and what follows is that counter trend or sideways price action. Again, it can be down sloping, can be sideways, but what's important is to observe that there's low volume, light volume during that consolidation period. The pattern completes within about 1 to 3 weeks. Okay, 1 to 3 weeks. Anything longer than that, you know, a consolidation period that lasts a month and a half, it's not really a flag pattern anymore, especially if it's a sideways consolidation period. We're looking more like a rectangle at that point. Okay. What I love about this pattern, as well as the triangles, is they have built-in profit objectives and stop loss levels. All right. The profit objective, or what's also called the measured move, is the length of the flagpole. Now we'll look at some examples, and I'll show you guys how to draw the flagpole itself. It's called a bull flag, so it consists of a flagpole and a flag. The flag is the downward sloping or sideways consolidation period that follows the flagpole. So the length of the flagpole is your measured move, and I'll show you guys how to measure it. If you do take the trade, if you get the breakout, your initial stop loss is the low of the flag formation. So this is what it looks like on a diagram. We're going to look at some charts, some real stock examples, but this is what it looks like on a diagram. So here's your flagpole. Here's your sharp up move. Okay, and I usually start the pole at at a breakout level. I'm not going to go all the way down here. Because here you had a little bit of a pullback. You had a breakout. It's not a science in terms of drawing the flagpole. Okay. Let's see. Can everybody see the diagram page? Michael's saying I'm only seeing the description page. Can everybody see the diagram page? Okay, Reginald says yes. Deanna says yes. All right, Michael, I'm not sure everybody is saying yes. So, okay, you see it now. Okay, a little slow delay there. Okay, fantastic. All right, so I'll show you again how to measure the pole, but you measure the flagpole. Whoops. Okay. And then what follows is that downward, in this case, it's a downward sloping consolidation period. So you have a lower channel line that connects the lows. You have an upper channel line that connects the highs during that consolidation period. You get a breakout, and most of the times it's clear. It's a clear breakout. That breakout needs to close above the upper channel line, and that breakout needs to be accompanied by high volume. You don't take the trade as soon as price crosses above that upper channel line intraday. You wait for the stock to close above that upper channel line. Then you enter the trade on follow through the next day. Okay? If you do take the trade the next day, where's your stop loss? Here the stop loss is the low of the consolidation period. I'd put it right a little bit below it, right? You don't want to put it right at it because you might get a retest of that price and you get stopped out if it hits it. You put it a little bit below the low of the consolidation period. Now the measured move is the length of the flagpole. So you take this price, you subtract it by this price, which is the top of the flagpole, you take the difference and you add that difference to the closing price of the breakout candle, and that is where your expected measured move is, and that's where you set your profit objective, your initial profit target. Okay, let's take a look at an example here. Don't worry about the time frame, guys. I'm going to show you a couple of real recent examples of trades that I actually took in our swing trading coaching group portfolio. I'll talk about that coaching group a little bit later, but these are historical examples. It's fine. And again, I'll show you some real-time examples. So here's Zebra. So there's your new high. There's your sharp up move. Look at that volume, accompanied by higher and higher volume along the way. Then you get this period of consolidation. You've been there, right? You've experienced this. This is sharp up move, followed by some profit taking, not a mass exodus, but some profit taking, a period of consolidation where this lower line here, pretty much connects the lows of the consolidation period. This upper line here connects the highs of the consolidation period. You do not take the trade anywhere within the consolidation period. You wait for the breakout above. You wait for the breakout above. You wait for that breakout to be accompanied by high volume. There's your trade. Okay. Yes, you will be able to get the slides, Michael. I'm going to put them in the handout section once I wrap things up here today. So there's your breakout. You don't take the trade that day just because price intraday breaks out above that upper channel line. You take it the next day. Price follows through. Price moves higher than the close of the breakout candle. That's your entry. Now that I take the trade and I know that I'm going to enter, where do I set my stop loss? Well, I know the low of the consolidation period is right in this area here, right? So I put it a little bit below it. A little bit below, that's where I would set my initial stop loss. If you're wrong, if it's a fake breakout, you do take the trade because price moves higher a little bit, but then reverses course. This is a quick in and out if the trade goes the other way. All right. Now, you know what? I should have drew this line maybe from right here. Here's where I would really draw the line. I'm sorry that I drew it from down there, but here's a kind of a little mini breakout, and that was the beginning of the sharp up move, right? So I draw my line from here to the top of the consolidation period. That's my flagpole. I take this price at the bottom of the flagpole. I take this price at the top of the flagpole. I'd subtract that price from that price, take the difference, add it to the closing price of the breakout candle, and that's where I would set my initial profit target, because the move after the breakout, or the next move after the consolidation period, is usually in the same direction as the prior trend. Now, what I like about this is it gives us a nice base, nice foundation. What I mean by that is you take the trade, you know where your stop loss is going to be, your initial stop loss, and you also have an idea of where you should set your initial profit target. Okay? It's a nice foundation. Are there going to be times where you may want to take profits before your initial profit target is reached? Sure, I have no problem with you doing that. And you know, it's your money. If you want to take as much off the table as you want, that's okay. But it gives us, again, a nice foundation to say, here's my initial profit target. Now, when you reach, if you reach that profit target, so John is asking, how do you determine the slope of the line you drew for the profit? Well, you know, we have the benefit now of knowing, because we have data after the breakout, how long that line should be. But if this was the hard right edge, you don't draw a line. You don't draw a line to determine your profit target, because you don't have any data after the breakout. You just add the price. So don't worry about the slope of the line, guys. The slope of the line is just following the price. Has nothing to do with anything. It's just me drawing a line the same length as the flagpole. That's what I tried to do here. And we reached that level. We reached that level. Okay? Oh, by the way, look at the period of consolidation and look at the volume that that accompanied that period of consolidation. Pretty much drying up. I mean, there's some exceptions, right, where you get a better, bigger volume bar. Okay? But sharp up move followed by, or accompanied by, higher volume, then a period of consolidation, and you can just observe, just look at the volume that's drying up there. Okay? Here's AMD. So here's your sharp up move. Look at the volume. Okay, now we're looking at a new 1 month high. So the stock price had been rising. Really nice up move, resulting in a new high, new recent high here. Then this period of consolidation that lasts for a couple of weeks. Okay, the down sloping consolidation period wasn't long enough to break the trend. Right, we're seeing higher lows here. You know, if this downward consolidation period lasted for a while, like follow my little cursor there, and then winded up breaking below this area here, the uptrend is over. We're not looking really at a continuation of anything anymore. Okay, so consolidation period, look at that volume, and then clearly you get the nice breakout. You get the nice breakout on high volume. Okay, we're not trading the stock anywhere during the consolidation period. I'm waiting for the breakout. So the stock price closed at the top here, and as you can see, the upper wick on the candle that followed did go higher than the close of the breakout candle. So theoretically, you could have taken the trade that day, could have taken the trade the day after as well. So one of the next couple of days, you do take the trade because price did cross above the closing price of the breakout candle. Okay. Now, where would I set my initial stop loss? Now, would I set my initial stop loss here? Is that really the low of the consolidation period? No, I'd set it right below in this area here. That's truly the lowest point of this consolidation period, and that's where I would set my initial profit, my initial stop loss. And what you have to do here is size your positions according to your max risk. And what I mean by that is, every good trader is going to follow what's called the 1 to 2% rule. Okay? Don't risk any more than 1 to 2%, trying to keep it closer to 1% of your overall portfolio value on any single position. Okay? So let's just say you had a $100,000 portfolio and you want to hold 5 stocks. You hope to put $20,000 into each stock. 1% of $100,000 is $1,000. So you don't want to risk any more than $1,000 on any single trade. If your position size is 20 grand per position, $1,000 of 20,000 is a 5% stop loss. That will ensure that you are abiding by the 1% rule. If you take a trade like this on a nice breakout and your initial stop loss there is more than 5%, well, you can't put 20 grand into the trade. You have to adjust your position size accordingly. You have to calculate what your max loss is from your potential entry to your initial stop loss. What percentage loss is that? Then figure out how to size your position according to that percentage loss. So let's say you wanted to put $20,000 into the position. You want to keep a 5% stop loss because that is abiding by the 1 to 2% rule. But this trade, I'm just spitballing here and saying that this might be a 10% loss, for example. Well, how do you then accommodate for the 1% rule? Well, you cut your position in half. You put $10,000 into the trade. If this will result in a max loss of 10%, that's still only $1,000. You're still abiding by the 1% rule. So you have to size your position according to what your max pain is for these trades, because it's different for each stock. Sometimes they're a little closer. Sometimes if I go back, sometimes the initial stop loss is much closer to your purchase price, so that you can leverage up a little bit and put more money into the trade. Okay, so again, that's where you set your initial stop. The flagpole is drawn pretty nicely here. I take this price, which is the bottom of the flagpole. I subtract it from this price, which is the top of the flagpole, and I add it to the closing price of the breakout candle. So again, because imagine this was the hard right edge, there'd be no line to draw. But because we have the benefit now of looking at data here, that is essentially the same level, the same amount of the flagpole. That's where the price actually paused here, and you think about taking gains off the table at that point. Okay, here's Regeneron. All right, so the stock was upsloping, then pulled back. Okay. Nice sharp rise in price resulting in a new high. Volume increasing. Period of consolidation lasts for about a week. Look at the volume that dried up there. Clear breakout. Clear breakout above the upper channel line there on really strong volume. I know it's tempting to say, man, I wish I would have gotten in right as price broke out. That's not textbook, okay? I'm trying to teach you the textbook approach here, and that's to wait for the stock to close above the consolidation period and then enter the trade the following day on confirmation. Clearly, we got confirmation the following day. The stock opened higher than the close of the breakout candle and continued to rise throughout the day, causing you to enter the trade. Now, where do I set my stop loss? Right below the low of the consolidation period. You have to calculate what percentage loss that might result in and size your position accordingly. Okay, I'll draw the line from here to here. Take that price, subtract it from that price, take the difference, add it to the closing price of the breakout candle, and that is the measured move. That's how far you should expect price to move to after the breakout. And the example that we'll look at, the real time or the recent example that we'll look at, I'm going to put some numbers to this. All right, just to give you an idea of an example with numbers, but it's not that important here. It's the technique that's important, and you understanding how to measure these levels and how to set your initial stop loss. Again, how to draw the pole, how to measure the pole, take that difference, add it to the closing price of the breakout candle, and then that's where you set your initial target. All right, the last flag that we'll look at, excuse me, ODFL, Old Dominion. Look at that, 1, 2, 3, 4, 5, 6, 7, 8 days in a row the stock price rises on some pretty good volume along the way. Now we're into this, about 2-week period of consolidation. The consolidation period doesn't result in a new low. That would just be a breakdown in the pattern and a breakdown in the trend. Okay, that period of consolidation, just overall, pretty low volume. And here is where you get your breakout. Nice breakout, decent volume that day. Follow through the next day on even better volume, and there's where you take the trade. You take the trade on confirmation. You set your initial stop loss right below the low of the consolidation period. You measure the flagpole. Okay. Now, you don't have to necessarily measure the flagpole until you take the trade. What you really want to pay attention to is the breakout first. Okay. Closing breakout. And then let's be really nimble. Let's try to get the best price possible the following day. Okay. For example, let's say the stock price opens lower than the close of the previous day. All right, so you're not taking the trade then, but if the stock price rises throughout the day, I want to get in as close as possible right above the close of that breakout candle. Now, in some cases, the stock will gap up, so you have to really be ready to enter, as price pulls away from the previous day's close. 9:45 in the morning is the earliest that I'll wait. I don't mind pulling the trigger at 9:45 if I see a nice rise above my confirmation level and a move away from that level. I'll be ready to get in as early as possible. Once you enter, okay, you know where your initial stop loss is going to be. Then you can measure the flagpole, and you can say, okay, I take that price, subtract it from that price. Then I can add it to the closing price of the breakout candle and know where my initial profit target is. Okay, let me show you a recent example. Here's Oasis, an oil company. Oil's been in favor for sure. Petroleum is our top sector in the program, and there's, I don't know, half a dozen petroleum industry groups at the top of the industry list as well. So this was a bull flag as of June 10th, wasn't it? I mean, it's the same pattern examples that I've been showing you. Okay, here's your flag pattern. Here's the flagpole. New high. Pretty good volume days. You had 3 or 4 days during that rise of higher than average volume. The blue line is the average volume, 50-day moving average. So generally speaking, you had a couple of nice days during that ascent where volume was trading above the average. Then you get this period of consolidation. Look at the volume. Almost every day during that period, you had lower than average volume. I remember 2 weeks ago on June 10th in our swing trading coaching group, I don't know if I think I did. I had this stock kind of in a watch list because I recognized this pattern. Sometimes in our swing trading coaching group, the students, the members of the group will say, "Hey Jerry, take a look at this stock. It's a nice bull flag, or it's a nice resistance retracement, things like that, whatever." And then we'll throw those stocks in a watch list as potential trades. This one was actually something that I recognized as of June 10th. That was a Thursday. That was a couple of Thursdays ago. We meet every Thursday for our swing trading coaching group. So I said, guys, this is a really nice setup. Really nice setup. I like this bull flag pattern, but let's wait for the breakout. We got the breakout the following day. Volume on that day was pretty good. It was about average, a little bit higher than average. The volume, the shares traded was 2.6 million, and the 50-day moving average was 2.5 million. So a little bit above average on that day. I didn't take the trade that day, but I took it the following day. Bruce says, would you use a buy stop order for this? Yes, if you can't watch the market the next day. Yes, you should put a buy stop order in the night before above the closing price of the breakout candle. But if you're able to watch the stock the next day, you're just waiting for 9:45 in the morning, price above your breakout closing price of the breakout candle, and pulling away, you take the trade. But if you're more comfortable buy stop orders, you can do that. I took the trade the next day. Okay, so let's put some numbers to this now. My initial stop loss, let me draw a horizontal line. I wrote on my chart here, I created a little note, $89.50. That's right there. Little bit below the low of the consolidation period. Let me zoom in so we can see it a little bit better. A little bit below the low of the consolidation period. That was my initial stop loss. My profit target is actually $114. This is what I did. I take this price, which is $78, which is the low of the flagpole. I take this price, which is $95, which is the top of the flagpole. What's the difference? 78 minus 95, that's $17. Add $17 to the closing price of the breakout candle, which is 95 bucks. That's 105. That's I'm sorry, no, it is 112. Excuse me, 112. $112. So I can't draw all the way to 112 because we don't have enough data. Now the stock has moved in my direction, somewhat profitable on the trade so far. Okay, we had 3 up days, you had a big down day, we had a little bit of consolidation here. I'm still in the trade because the stock closed today at $100.87. Clearly not at my $112 initial profit target. Okay, so this is a recent example here of a bull flag that I traded in our swing trading coaching group. Good setup, good breakout, good follow through. I set my initial stop loss right below the low of the pattern. I measured the flagpole. I added the difference to the closing price of the breakout candle and draw some note, drew a note on the chart letting me know where my levels are. Okay, so that's a bull flag. Okay, really solid pattern. I love recognizing those. I love trading those patterns. Pretty reliable. You want a nice strong uptrend to begin with. You want that sharp up move on higher volume. The period of consolidation should last for a week or two. All right. You want volume to dry up during that period. A good breakout on high volume, and that's where you take the trade. And again, I like that pattern because, it already has that stop loss level baked in and your profit target. I mean, how many times can you say that? Where every trade that you take, where your stop loss level is empirically, no denying it, and where you should be taking profits. Okay, I like that pattern. So now we're going to talk about a triangle, and specifically the ascending triangle, which is bullish. So with triangle, you're looking at price consolidations that begin to narrow in a sloping direction. I drew those diagrams of the 3 different types of triangles: the symmetrical, the ascending, and the descending triangles. So you saw how it looks like price consolidation. It's narrowing, coming to a head in a sloping direction. Sometimes it's sloping down, sometimes it's sloping upward. Volume is decreasing during that period, during that formation. So, especially when you get closer to the apex, the point of the triangle. You're looking at drying up volume, but uh, during that period there is some volume that's decreasing, but we want to make sure that there's an increase in volume on the breakout. And the measuring objective is the distance from the top to the bottom of the triangle. Okay, so let's take a look at it. Here's an ascending triangle pattern. Again, it's just a diagram. We'll look at some examples in a moment. So here you have this level of resistance, 1 touch, 2 touches, 3 touches, 4 touches, but at the same time, it's accompanied by higher lows. Okay, then you get your breakout above resistance. Same thing, you wait for the stock price to close above resistance before taking the trade. You don't just take it intraday as price rises above that resistance level. Excuse me. You wait for follow through the next day, you take the trade. Your initial stop loss is the last retest of the lower trend line. So you're connecting the higher lows and you're setting your initial stop loss essentially at the last higher low, right below it. Right below it. There's another variation to an exit strategy. If you do take the trade on follow through, okay, this is more of an aggressive type of a stop loss because it's much lower than your purchase price. Opens yourself up for a little bit bigger of a loss. Remember, you're going to size the position according to what that loss is or may be. But a little bit more of a conservative exit is right below support. Remember, this is resistance. So if price breaks out through resistance, follow through, that resistance level becomes support. If you do take the trade, you could put your initial stop loss right below that support level. That's a little bit more conservative. It's a little tighter. I don't say to put it right at support, because what I see a lot is price breaking out and then retesting that level, retesting that support level. Okay. All right. So here's HELE stock example. Here's your rally, your retreat. The retreat results in a higher low being put in. There's your rally. That results in a pause at the most recent high there, establishing your level of resistance. There's another retreat, but another higher low is being put in. There's your final retest of resistance, and then there's your breakout. Okay, it doesn't have to be a 15% day when price breaks out above it. It has to close above resistance on good volume. You can see volume was a little bit higher than average on that day. And during this period of consolidation, what are we seeing, especially late in the pattern? Lower than average volume. Okay, so you get your nice breakout, pretty good volume. You get your follow through the next day. Price did go higher than the close. Okay, 2 ways to manage the trade. You can put your initial stop loss right below support. It's now support, right? Because price is above that former resistance level. Or you can put it right below, I'd put it probably right in this area here, right below the last retest of that trend line. If you do put it down there, you really have to pay attention to the size of your position. You don't want to open yourself up to too big of a loss on that position where it outsizes your 1% rule. Now here's where you measure your initial profit target. There's the slide before says you take the width. What does it say? It says, oops. It says distance from the top to the bottom of the triangle. Well, there's a lot of distances from the top to the bottom. Well, I don't want to get too greedy. I'm not going to draw it from back here. Okay? And I'm not going to be too conservative where I draw it from here. I'll split the difference. This is where I'll draw my measured move. I'll kind of go right in between. I take this price, I subtract it from this price, I take the difference, I add it to the closing price of the breakout candle, and that's where you set your initial profit target. Again, we have the benefit of seeing data after the breakout. So, looks like we got there. Looks like we reached our initial profit target. But in real time, you don't have that benefit of future data. So you're just mentally adding that number. You're adding the difference between the bottom of the triangle, or where you measure it from, to the top of where you measure it from. Then you add it to the closing price of the breakout candle, and that's where your initial profit target is. You don't draw a line after that. I've been doing that as some examples here. All right, here's TREX. So here's your rally off of the low. There's your retreat, put in a higher low. There's your retest of resistance. I mean, intraday hit basically right to the penny. There's your retreat again, but another higher low was put in. There's your ascending triangle. There's your breakout. Breakout, good volume. And look at the volume, guys. For the most part, I know we got this big redwood in there, but look at the volume for the most part, especially late in the pattern, drying up. Okay, nice increase in volume as the stock breaks out. And here's another way to trade it. So I talked about another way to manage the trade. Another way to manage the trade is, instead of putting your initial stop loss right below the low there of the last touch of that trend line, I said you could put it right below support. Another way to execute the trade is not trading the breakout, but trading the retest of support. And an example, I'm going to show you a recent example, is that's what I did. I didn't trade the breakout. I think I missed the breakout. It was a stock that someone brought to my attention in our coaching group, but it was a little late. The stock had already broke out, but they know enough now from being in that group for so long, that says, you can trade the retest. Well, hey, Jerry, we missed the breakout. Let's wait for the retest. And that's exactly what happened in the example that I'll show you in a moment. We traded the retest, and we had a nice gain on the trade. Okay. William says, do you personally move your stop up at any point? Yes. So I absolutely will move my stop up once my initial profit target is reached. Because once my initial profit target is reached, I will take half of the trade off, literally sell half of my shares. Then I'm not going to keep my initial my stop loss at the same level. What I'll do is I will at least raise it to entry, so that if price falls after it reaches my profit target and it falls, I don't want to lose money on the remainder of the position. So I will at least raise my stop to entry. So if it falls back to entry, yes, I gave away the profit on that second part, or that remaining part of the trade, but taking my profit nets me a gain on the trade, a winning trade. Okay, and if my initial profit target is reached, here's where I'll draw, right? Initial profit target is reached, which is about that level. Then I will once I take half off, again, raise my remaining stop to entry. If the stock keeps running, I keep raising that stop, right? I'm getting closer as the stock runs away from my initial profit target, and the second half of the position runs. I'm raising that. I'm raising it tighter and tighter as the stock runs. Okay, below the recent lows. That's where I'll put my remainder of the stop. Okay, Paul says, do you look for a retest on inside the daily as confirmation of the retest? Rephrase that, Paul. Do you look at a retest on inside the daily? We're looking at daily charts. I'll show you what a true retest looks like. Okay. Here's CDE, same thing. There's your low, there's your rally, there's your retreat, higher low, there's your rally, establishing a really strong level of resistance here, higher low, higher low, higher low, another higher low, then you get your breakout. Get your breakout on some really good volume there. Okay, you take the trade. You can either set your initial stop loss right below support or right below the low of the last pivot, the last touch of that lower trend line. I'm not going to measure my move there. I'm not going to be too conservative and measure it here. I'll go right in the middle. I'll take this price, I'll subtract it from this price, I'll add it to the closing price of the breakout candle, and that's where my expected move is set to. All right, so here's a recent example. Okay, Moderna. You're welcome, Paul. Moderna. Okay, so what are we looking at here? All right, so we can kind of play this out. Is the stock hitting new highs? It's not. Okay, it's failing to rise above $189, right? It did so here. That failure there, that establishment of resistance, along with, I could pull this back a little bit further, these higher lows that are put in. Like I can't really draw it from here. It's not really clean. So I take it from there, but I recognize that that higher low is higher than that higher low. Okay, so if we play this out moving forward, price rises and rallies off of another higher low, that's another one, right? And it approaches resistance again. This hard right edge here was May 28th. I missed the breakout. I missed the breakout. Okay, so one of our folks in our coaching group brought this to my attention and said, Jerry, look, price is now retesting that support level. And if I put support and resistance on and take off this line that I drew, puts it right there. And this retest now, breakout and retest, look at where that candle landed. Right in the zone. I took the trade the following day off of that support retracement. Okay, off of that support retracement. And I used a different method to size my position and set my initial stop loss. I actually used 2 ATR, okay, which happened to be at about 182 bucks, right below support. So I put my initial stop loss right below support. Now 2 ATR winded up being right below support, so it worked out perfectly. Okay, remember where your other stop loss could be, right? You could use it or set it right below. Let me take off support and resistance. You could put it right there, right below the last retest or last retracement off of that trend line. I decided to raise it a little bit and put it right below support, which happened to be 2 ATR from my purchase price. Yeah, Kirk says this is a mental stop, correct? Not a stop with your broker. Correct. I don't put stops in with my broker. I don't mess around with that stuff. Too much funny business, right? That goes on. I know where my stop is going to be. I'm able to watch the market all day long. I don't put any stops in with my broker. If you can't watch the market, that's a different story. You don't mind putting stops in with your broker, you can do that. Yeah, Michael says if you don't catch the breakout, then you do not get in a day or two late. I don't like to do that. If I miss the break, I want to try to get in as early as possible as the breakout. If I miss the breakout, I don't want to chase. I'll wait for the retest. If I don't get the retest, so be it. You miss out on the trade, but I don't want to chase the breakout. I want to catch the breakout right when it happens. So I took the trade on that day, the day off of the retracement, and in this case, I set my initial profit target at the most recent high, and we got there today, and I took half the position off. I took half the position off and I raised my stop, which was 182, right below support. Now it's at entry, right in that area there on that little green candle, so that if the stock price falls back to my entry, I don't make any money on the remainder of the position, but I net a gain on the trade itself because I took half off already. Okay, so another recent example there. Well, guys, I want to thank you guys. Let me just make sure you can see my, there we go. I want to thank you guys for joining me today. If you don't mind sticking around a little bit, I want to talk to you guys about some more of this. Now, this is a course that we put together, myself, Steve Chappell, Dr. David Paul. It's called Precision Swing Trading. And you'll notice in Module 5, we teach you triangles and flags. What I'm also going to do in this course is teach about pennants and rectangles as well. Okay, module number 4, you can see we talk about double tops and bottoms and inverse head and shoulders patterns. Those are all reversal signals. And with those 2 modules there, what I love about them is they already have predetermined exits and stop losses and profit targets. It's already baked in. So we go through those levels during those modules. So all of these modules are pre-recorded. Okay, upon registering, we'll talk about how much the course cost in a second. You get all the modules up front. Now, if you don't have VectorVest Premium, which is our real-time package, we're going to give you 60 days access to it. If you're not a VectorVest subscriber, let's say you're joining us via YouTube and you've been looking for a course like this, you don't have VectorVest at all, we're going to give you our 60 days access to VectorVest Premium, which includes all the tools required as part of the course. And that trial, if you don't already have it, will begin on June 30th. I talked about our swing trading coaching group. Okay, we meet every Thursday at 2:30 p.m. Eastern Time, and it's an hour and a half. What you're going to get also is access to 6 of those coaching sessions for the duration of the course, and they will begin the first week of our live mastery support session. So I said that the modules are pre-recorded, but we're going to be doing 6 live mastery support sessions during this course. The first session is July 6th. All of the sessions begin at 2 p.m. Eastern Time. So what I want you guys to do, and I'm going to put the slides in the chat box in a second. I want you to go to vectorvest.com/PST. I put that in the chat box so you can just click on it. Okay. And what we're also going to do is do a bonus session. This bonus session is called How to Short Stocks with Confidence. We're not going to talk too much about shorting during the course, but we're going to talk a little bit about shorting stocks in our bonus module. This will be on August 17th at 2 p.m. Eastern Time as well. Okay, now the course is normally $995, but we are extending our Father's Day special, which we started about a week or so ago, till the end of the month. So for $495, you get all 6 pre-recorded modules, all 6 mastery support sessions, 60 days access to the VectorVest Premium package if you don't already have it, the bonus module, How to Short Stocks with Confidence, and the 6 coaching group sessions as well. Now those sessions, those coaching group sessions, they'll be recorded and they will be uploaded into your precision swing trading outline. Okay, your precision swing trading outline. Okay, the slides have been inserted and they are in the handout section of your GoToMeeting control panel. It should say handouts 1 of 5, and it's a PDF. John says, how does this class play with options instead of buying the underlying stock? We don't get into that, John. This is not an options course, so it's hard to say how it plays in because you have to do all of that due diligence in terms of the option pricing and volatility. We're not doing any of that. If it's a bullish breakout, it's potentially a bullish option trade. Now there are other variables that you have to pay attention to, which again we don't get into here. Okay. Paul, I'm not even sure what those are. Multi-correction patterns, so no. The mastery sessions will cover the content in each module. So for example, module 4 is head and shoulders, inverse head and shoulders, double tops, double bottoms. Those are reversal patterns. The patterns that are taught during the module, they're historical examples similar to what I showed you guys here today. In the mastery sessions, we try to look at the real market, the current market at that time, and we try to see if we can find any of those patterns. So you're able to recognize them in real time. Okay, you have etched in your mind from historical examples what the patterns look like. Therefore, it's easier to then to recognize them moving forward, just like I did with OAS and Moderna. I understand what the patterns look like historically, so you get better at recognizing them in real time. Okay, so you go to www.vectorvest.com/pst, purchase the course now. Again, that $495 rate, guys, it's not just a act now price. That Father's Day special rate is going to be available to the end of the month. Okay, so you have some time. We really look forward to working with you. So Rajit says the 2 p.m. time for a mastery session is 2 a.m. in Singapore. Can this be changed to like 10 a.m.? No, unfortunately, it can't, just due to scheduling conflicts, Rajit. Unfortunately, 2 p.m. is the time slot we have allotted for this session. Now, the sessions are going to be recorded. All right, the modules are pre-recorded. Once you register for the course, you'll get an email with directions on how to access the course. You can watch all the modules now before our first mastery session in a couple weeks. But the mastery sessions that we do, they will be recorded and uploaded into the university as well. Okay? So there are no searches for particularly the reversal and continuation patterns that we teach in this course. There are no scans. I mentioned earlier that it's primarily a cherry-picking chart reading approach. Now in modules 2 and 3, where we teach you about ADX and RSI and stochastics and MACD and moving averages, there are scans for those setups, but not for the reversal and continuation patterns. And that's purpose. That's intentional. I want you guys to. I don't want to make it too easy for you. I said earlier, I love scans. Look, first of all, there aren't any scans in the VectorVest program to find those patterns. So that's number one. It's not like I'm hiding them from you or just not giving them to you. They're just not available inside the program. Okay, so this is a course in chart reading, recognizing these patterns, and then reacting to them. All right, guys. I look forward to working with you. Myself, Steve Chappell, Dr. David Paul. You got a really good group of instructors. We're going to take you guys through the 6-week course. Looking forward to working with you. If you have any questions on anything that I talk about here today, you can shoot me an email at jerryd, Jerry, D as in David, at VectorVest.com, or just give our support department a call. Oh, by the way, you will get a recording of this webinar. Now, I did one earlier at noon today, and what we usually do is I tell our marketing team to send out the best one. You might be getting this one, you might be getting the one that I sent out or I did today at noon. I just got to figure out which one I liked better, and we're going to send that out to you. Same concepts, nothing at all is different. So you're going to get a recording of today's content a little bit later this evening. All right. Have a great evening, everyone. Tomorrow's Thursday. Look forward to working with you guys that do register, and we'll see everybody soon. Take care, everybody.